Please make sure to check that your phones and smartwatches are on silent mode to ensure the smooth running of this second panel discussion. And the theme chosen for this second one is addressing the tax challenges arising from the digitalization of our economies towards the implementation of the OECD Two-Pillar Solution. So if you allow me to extrapolate a bit more on this, digitalization, together with globalization, has transformed our economies over the last 2 decades and has brought new challenges to the rules for taxing international business income. Further to several years of negotiations, the statement on the two-pillar solution to address the tax challenges arising from the digitalization of the economy was adopted in 2021 to ensure the multinational enterprises will be subject to a global minimum tax of 15% and will partially reallocate profit to countries worldwide. Today, 137 countries around the world, including 22 in Africa, have joined this initiative. So allow me to call upon the panelists. So please put your hands together. His Excellency, Dr. 𝗂𝗐𝗍 𝗏, Director General of the Arab Bank for Economic Development in Africa. Can you please join us on stage, please? Mr. Régis Nsonde, Alternate Executive Director for the IMF. Mr. Rajesh Sharma Hamlul, Solicitor General. And Mr. Sudha Mulal, Director General of the Mauritius Revenue Authority. And to moderate this panel discussion, let's give a warm welcome to Ms. Grace Perez Navarro, Director of the OECD's Center for Tax Policy and Administration. And similar to the first panel discussion, we shall be having a 15-minute question and answer session after this 45-minute discussion. So ladies and gentlemen, the floor is yours.
Hello, good afternoon, everyone. It's a great pleasure to be here with you in Mauritius. I'd like to thank the Mauritian government for inviting the OECD to participate in this panel. I should clarify that although the title says it's the OECD Two-Pillar Solution to the tax challenges of digitalization, as our MC mentioned, this is a two-pillar solution that was developed and agreed by 137 countries and jurisdictions participating in the inclusive framework on BEPS, on base erosion and profit shifting. Now, I know that most of you in the audience are not tax experts, and so this is maybe a challenging topic, especially at the end of the day when you have a beautiful beach awaiting you outside. But I thought I would try to maybe give a bit of the history before inviting our distinguished panelists to give their views on this, to explain a bit how we got to this two-pillar solution. Now, this all started really with the global financial crisis in 2009, when the G20 leaders realized that it was no longer acceptable to allow secrecy, to permit tax evasion around the world. And so they addressed that issue through changes that have been implemented through the Global Forum on Transparency and Exchange of Information for Tax Purposes, which counts 165 members, and of course Mauritius, and I believe all of the countries represented here are participating in the Global Forum. But in addition to tackling the issue of tax evasion, they also felt it was important to tackle the issue of aggressive tax planning by multinationals. And so in 2013, we were asked at the OECD to develop some measures to address this issue. And that's how we came up with the 15-point action plan to counter base erosion and profit shifting. BEPS, an acronym that is very common among the tax world, but maybe not so familiar among central bankers. Now, this action plan contained 15 different measures, and the first measure was to address the tax challenges of digitalization. And ultimately, where we got to on that, where we reached consensus, because this is how we operate, was that we would wait and see what the other measures would do to address the tax challenges that related to aggressive tax planning. However, the report that we published in 2015 identified one issue that countries were not yet ready to address, and that was the allocation of taxing rights in this context of increased globalization and digitalization. And we said we would get back to it in 2020, and in the meantime, see how the other measures were working. Well, this was a nice idea, but in 2017, ministers of the G20, led by Germany, said, no, we can't wait. We need to address this issue. And so that is why we started working on what has ultimately become the two-pillar solution to address the tax challenges of digitalization. And one of the key issues here is the fact that the international tax rules, as they currently exist, the international tax rules that have governed cross-border taxation for over 100 years are fundamentally based on having a physical presence. A lot of taxation depends on that. But as we've seen from the previous panel and discussions this morning, the Prime Minister's speech, that digitalization is taking over everything, and we must be ready to embrace it and harness the benefits of that. But it also produces challenges, because now very large multinationals can engage very actively in the economic life of a country without having a physical presence. And so who gets to tax the profits? Well, under the existing rules, many countries felt that the allocation of taxation rights was not adequate to deal with that, because even though there may not be an adequate or any physical presence at all, there still were substantial profits being earned in countries by these major multinationals. And so that's how we launched this project. And the two pillars essentially cover two components. The first is dealing with this issue and more broadly, because many multinationals, apart from the digital companies, are able to earn very substantial profits from intangible property. And again, there may be issues of having a physical presence. And so we wanted to make sure that we covered digital and beyond to really fundamentally change the international tax rules to allocate more taxing rights to the source country. And so what this means for developing countries, which tend to be source countries, is that they will be getting more taxing rights out of this first pillar, which is focused on the largest multinationals in the world, and also has a new innovation in that it applies a formulaic approach to this as opposed to the traditional transfer pricing rules that we have used in the past. The second pillar establishes a global minimum tax of an effective rate of 15%. Now, this is really important because it's sort of the ultimate backstop to all of the other anti-avoidance rules, because it says no matter what a multinational does by shifting profits here and there, if they're not paying at least 15% at an effective rate, not the rate in the tax law, but the actual effective rate of tax, then that will be taxed. And it will be taxed either in the home jurisdiction of the company or in that source country. And that source country will have the first right to tax that income. And so these are very fundamental changes in the international tax architecture. We have finalized the legal rules for this minimum tax. We have published on the two pillars 2 progress reports that set out the parameters of this new taxing, right? And we've issued these progress reports for public consultation. One we've already received substantial comments. The other one has been out for public comment right now. And so this is very much an active discussion and negotiation, and it is a negotiation. We're talking about who gets to tax what, so not always easy. But the fact that we have reached consensus on the minimum tax, the fact that we have reached consensus, we reached consensus on this two-pillar solution back in October of last year, is very significant. And so we're now headed towards the finish line with the aim of establishing a multilateral convention over the coming months that then countries would be invited to sign by the middle of 2023. So with that broad overview, and I apologize for taking maybe more time than a moderator should, but given that this is not a tax audience, I thought I should give that background. But I would now like to turn to the distinguished speakers that we have to get their views on this two-pillar solution. And I would like to invite first His Excellency Dr. Sidi Ould Tah, the Director General of the Arab Bank for Economic Development in Africa, to share with us his views.
Thank you very much. Permettez-moi tout d'abord donc de présenter mes sincères remerciements aux autorités de Maurice, en particulier à son Excellence Monsieur le Ministre des Finances, qui nous a invités pour participer à cette importante conférence internationale. Et je voudrais saisir cette occasion pour féliciter donc Maurice pour les avancées importantes réalisées par ce pays en matière de développement économique et social. Je voudrais aussi profiter de cette occasion pour témoigner des avancées notoires réalisées par l'OCDE depuis que j'ai participé il y a plus de 10 ans à une conférence de l'OCDE sur la transparence fiscale et ayant participé personnellement aux premières réunions des groupes sur comment l'Afrique pourrait donc se joindre au Forum international pour la transparence fiscale dans une vie antérieure. Je voudrais réellement dire toute mon admiration pour le travail accompli par l'OCDE dans ce domaine. Travail qui devient aujourd'hui encore beaucoup plus compliqué par la transformation digitale que le continent est en train de connaître et le monde entier. Et comme vous le savez, aujourd'hui, l'économie digitale devient une réalité qui est en avance par rapport aux régulateurs. Et c'est un domaine dans lequel nous avons aujourd'hui un paradoxe assez important, car normalement les régulateurs précèdent l'activité, mais dans ce cadre, on a toujours une avance au niveau de la réalité sur le terrain par rapport à la régulation. Et pour ce qui est du cas particulier de l'évasion fiscale et surtout d'une imposition juste par rapport aux multinationales en Afrique, c'est une question qui est au centre de toutes les politiques économiques aujourd'hui en Afrique, et les banques de développement comme la Banque arabe pour le développement économique en Afrique, BADEA, sont appelées à apporter leur soutien au gouvernement donc dans les recherches d'une justice fiscale, particulièrement par rapport aux ressources naturelles. La Banque arabe pour le développement économique en Afrique, pour ceux qui ne la connaissent pas bien, est une institution multilatérale dont les actionnaires sont 18 pays arabes et dont le mandat est exclusivement sur les 44 pays africains non membres de la Ligue arabe. La banque offre des financements sous concessionnels, mais aussi offre des financements pour le secteur privé et le commerce, en plus de dons pour l'assistance technique au gouvernement. Et dans ce cadre, la banque soutient les efforts des pays bénéficiaires de ces financements en matière de réforme et en matière de développement institutionnel. Et la banque aussi, et je crois que la question a été déjà soulevée lors du panel qui nous a précédés, la banque contribue au financement des infrastructures digitales et accompagne les États dans le développement de leurs infrastructures, mais aussi accompagne les petites et moyennes entreprises, car la stratégie 𝗵𝗵𝗶𝗴𝗶 2030 est une stratégie axée autour de 4 piliers, et l'un de ces piliers, c'est surtout le développement des petites et moyennes entreprises. Et comme vous le savez, les petites et moyennes entreprises représentent à peu près 90% des tissus économiques en Afrique, et il est extrêmement important donc de les accompagner pour leur permettre d'abord d'avoir accès au financement. Seulement 20% de ces petites et moyennes entreprises ont accès au financement, mais aussi dans la recherche d'accès au marché, aussi bien au niveau national, régional, continental, mais aussi international. Et pour revenir à la question donc de la fiscalité, aujourd'hui la digitalisation est une arme à double tranchant. D'un côté, elle aide les gouvernements à mieux cerner l'assiette fiscale, à mieux cerner les contribuables à travers l'identifiant fiscal unique, qui est appelé dans certains pays le NIF, numéro fiscal, numéro d'identification fiscale, mais aussi elle permet une mise à contribution des différentes données disponibles au niveau aussi bien de la dépense publique qu'au niveau des services de recettes. Car, comme vous l'avez certainement connu dans certains pays, il n'y avait pas de dialogue entre les services des dépenses et les services des recettes, et parfois les déclarations faites au niveau des services fiscaux sont très en deçà de la commande publique auprès des mêmes opérateurs qui sont engagés dans la commande publique. Maintenant, au niveau international, la question est beaucoup plus compliquée parce qu'il s'agit de multinationales qui ont des ramifications assez importantes et qui ont des comptabilités assez complexes. Et effectivement, cela requiert une coopération internationale accentuée. Et c'est là tout l'intérêt donc de l'initiative de l'OCDE pour un traité multilatéral qui va permettre donc de mettre les bases de réglementation unifiée pour tous les pays, mais aussi pour permettre de dégager des pistes pour mieux cerner l'assiette fiscale et mieux cerner surtout aussi le commerce international qui devient de plus en plus complexe, surtout avec les e-commerce et les activités transfrontalières. Voilà a priori les points que je voulais mettre sur la table en début de ce panel.
Merci beaucoup. And thank you very much for those comments. I think you're right, and one of the reasons that we launched this initiative is precisely because there is complexity, great complexity in the operations and accounting of multinational enterprises. And by bringing all countries together to try to find a solution to be able to tax these multinationals in a fairer way was really the key objective of our work. Now, let me turn to Régis Masonde, the alternate executive director at the IMF, for his thoughts on these developments.
Thank you, Grace, and thanks for setting the stage for this discussion. Honorable ministers, honorable governors, honorable heads of international institutions, distinguished guests, let me begin by thanking the authorities of these beautiful countries for organizing these important events and for... Hello? Yes, you can. So I was saying I would like to join Dr. 𝗏𝗏 to thank the authorities of these beautiful countries for organizing this important event and for the very warm welcome. As emphasized many times during this conference, digital transformation brings significant benefits and opportunities, and here I want to recognize the richness of the contributions from speakers from the first panel. Digitalization has also raised several policy challenges. It has a wide range of implications for taxation, impacting tax policies and tax administration at both domestic and international level. The inception of the two-pillar solution to address tax challenges stemming from digitalization has been a key milestone in the global debate on ensuring that the international tax rules are adequate and fair in an increasing, evolving environment. So following the insightful remarks by Dr. 𝗏𝗏, let me make the following points. First, I would like to say from the outset that I very much welcome this historic new global tax agreement known as the OECD Two-Pillar Solution. And the IMF has played an active role in this achievement and in other discussions on international tax issues. These include active involvement in the OECD-led inclusive framework, in working parties, and in the platform for collaboration on tax. For instance, international tax issues have been assessed in a number of Article 4 reports. For those who know, Article 4 reports are the reports issued by the IMF on its surveillance activities on countries. Also on several papers that have been published by the IMF, including spillovers in international corporate taxation, issued in 2014, and corporate taxation in the global economy, issued in 2019, among other publications. The collaboration with the OECD has been quite strong. Multilateral efforts and a global policy coordination on tax matters should continue. Second, regarding Pillar 1, the reallocation of profit and taxing rights. The departure from the so-called arm's length principle is a win, as the formulary method is more robust to manipulation and maneuvering. Also, the intending removal of unilateral digital service taxes will address concerns about the ring-fencing of a digital economy. However, implementation challenges remain, notably for developing countries, as the new taxing rights under this Pillar 1 superimposes on existing tax system, and this complexity may lead to double taxation. In addition, one will note the very small scope under the Pillar 1, affecting only about 100 companies worldwide, and the limited revenue gain, which will amount to 0.2 to 0.5% of global corporate income tax revenue, according to the OECD's own estimate. Regarding Pillar 2, I believe that the introduction of a minimum global tax floor of 15% on large multinational enterprises is an important step, which will yield major benefit in combating profit shifting and reducing tax competition. And it should bring significant revenue gain in the order of 6% of corporate income tax revenue, including for developing countries and low tax jurisdictions. For example, an IMF staff report on tax avoidance in sub-Saharan Africa's mining sector, published in 2021, corroborates the notion that reforms to introduce a global minimum effective corporate tax under Pillar 2 will provide producing countries a new mechanism to ensure that some corporate tax is paid by mining multinational enterprises. This approach would also lessen pressures for corporate tax competition and tax holidays intended to induce investment. Precisely on the caveat, there is a provision under Pillar 2 regarding carve-out. I personally believe that this is needed to accommodate tax incentives for business or economic activities that can be macro-critical, that is important very important at the macro level for some countries. We have to come to realization that such incentives can be justified, and this is for national authorities to decide based on their country's circumstances. But what is important is to ensure that those tax incentives and tax holidays are not permanent regimes that will benefit those multinational enterprises at the expense of tax revenue. Like Pillar 1, low-capacity developing countries will face constraints in implementing a complex reform under Pillar 2 and may well opt out and impose simpler domestic minimum taxes, which, while understandable, will defeat the purpose of a coordinated multilateral solution. Also, without being too technical, developing countries require cooperation in the implementation of the so-called subject to tax rule, by which including framework members that apply nominal corporate income tax rates below that RCTR minimum rate to interest, royalties, and some other payment will implement this STTR rate into their bilateral treaty with those developing countries when those later request so. And you can understand that this cooperation from other members on this demand is not given. Therefore, a stronger STTR may be needed. Another issue relates to the agreement implementation timetable, which is set to be completed in 2023. One can argue that this ambitious objective did not fully integrate the national legislative processes, which can be lengthy in some IF countries, inclusive framework countries. So all in all, the two-pillar solution agreement represents great progress, but there is significant room for improvement. I'm the first to recognize that the task is challenging. Discussions to improve the agreement and ensure a smooth implementation should continue, including on issues relevant for developing countries with a potential pillar 3. Many countries will need tailored advice and support with the implementation of the agreement, and the fund stands ready to provide further analysis and support through capacity development assistance. This has been stressed in a board discussion on this issue, and on which I'm not able to provide more specifics. Finally, and I will finish where I started my remarks, continued, and a point also raised by Dr. 𝗏𝗏, continued international cooperation and multilateralism are paramount for successful implementation of the agreement. Considering the complexity of the issues at hand, looking ahead, the fund should leverage its universal membership and continue to proactively work with the OECD and other institutions to help simplify the rules for the framework to fit its purpose, and each institution being mindful of its own mandate and expertise. I will stop here. Thank you, Grace.
Thank you very much, Régis, for those comments. We have been working very closely with the IMF on this, and we appreciate that. We also work with other international organizations through the Platform for Collaboration on Tax that Régis just mentioned, which includes not only the IMF, but the World Bank and the UN, as well as the OECD. I very much appreciate your comments about the support that the IMF will give to countries. Also acknowledge the comments you made about the need for further simplification in the implementation framework that we are working on right now for the implementation of the minimum tax. We are indeed looking at safe harbors and other ways to try to simplify the implementation. We recognize that these rules are complex, and we'll try to see how we can make them easier to apply. The other thing that I think that is important in the context of Pillar 2 that you mentioned is the whole issue of tax incentives. On the one hand, Pillar 2 and this minimum tax will help developing countries greatly resist the pressure that they often receive from businesses to offer tax incentives, wasteful tax incentives. Why do I say wasteful? Because it's likely that many of these investments would be made without the tax incentives in any event. And so the Pillar 2 minimum tax is an opportunity for governments to rethink the types of incentives that they offer. At the same time, as Régis just mentioned, incentives can be useful for governments, especially developing countries, to foster greater investment. And so it's really a question about rethinking incentives. And we also do have in the Pillar 2 architecture a carve-out for incentives related to substance. But let me stop there in commenting on those comments. We've now heard from a regional bank, an international organization. Now let's hear from Mauritius, one of the countries that is actually implementing these measures. And so we will start first with Mr. Sultamo Lal, the Director General of the Revenue Authority here, who really is the person on the ground who will have to implement these measures. Please, have the floor.
Thank you, Grace. A development of two-pillar solution marks a significant milestone in taxation of MNEs, even in the field of taxation, because digitalization together with globalization created a lot of challenges, as the classic substance of taxation being the physical presence evaporated in space. My two colleagues, the learned speakers, explained the two-pillar solution in general terms and their impact. I would restrict it to the case of Mauritius. In 2006, Mauritius joined Inclusive Framework. In Inclusive Framework, there are more than 137 countries as members committed to find the solution in the so-called tax evasion and the anti-avoidance. And with the work of the Inclusive Framework and the OECD, we do have a tangible thing on the table, that is the two-pillar solution. Mauritius, in fact, adopted the BEPS, adopted the 4 minimum standards of BEPS, and then removed the harmful practices from the preferential regimes, and it also encouraged the inclusion of substance in the administration of the entities. Mauritius, in fact, is a very active player at the OECD in adopting the recommendations. Mauritius did not resort to digital service tax as was introduced by some African countries and also European countries like Austria and Hungary, France, and even in India was the pioneer in this, because we believed that imposing any tax on online advertising was in fact taxing your local incomes, whereas the object was to take share of the fair taxation, to take the share from the big global companies. So we thought that the incidence of the tax was not at the intended, therefore we didn't go for DST. Now, since we have the two-pillar solution, Mauritius has made legislative amendments giving power to the minister to make regulations, and regulations are being made and they will be adopted once the model rules from the OECD are in place as far as two-pillar solution is concerned. As far as Pillar 1 is concerned, it applies to the very big multinational companies having a turnover of more than 20 billion euros. Obviously, there isn't any company in Mauritius, but then the companies, those companies have subsidiaries, and there are some in Mauritius. And Pillar 1 envisages that these companies will pay tax not only at the place of their domicile, but at the places from where they earn the income, from where the business is. And Mauritius hopes to get some additional taxation, some additional input as far as Pillar 1 is concerned, because in case of Mauritius, the limit of the constituent subsidiaries is 250,000 euros. We do believe that at certain time OECD will revisit this limit, and once this limit is lowered, Mauritius will gain on this account. As far as Pillar 2 is concerned, that we are talking of the companies having turnover of more than 750 million euros, and these companies, it is envisaged in Pillar 2 that they will pay tax not only at the time of their effective tax rate should not be minimum below 15% at the place of domicile and at the place of the source. And in this thing, the detailed rules have also been made. We believe that although the Mauritius has a headline taxation rate of 15%, but we have much lower tax rate also in some circumstances. And in those cases, resort to qualified domestic tax will probably give some revenue to the Mauritius, because in the two-pillar solution that is provided. As far as the applicability of this tax under Pillar 2 is concerned, there are many companies in Mauritius we have seen, they are below 1 million, and thus under the de minimis rule, this applicable conditionality of 15% may not apply to them. As far as STTR is concerned, subject to tax rules, we believe that royalty is taxed in 15%, so Mauritius would not be able to get anything under that account. But as far as interest is concerned, our rate is less. But again, we have seen that with the double taxation agreement, the bilateral treaties which we have, the only concerned countries would be three, that is Bangladesh, Congo, and Morocco. Bangladesh, Congo, and Cyprus, and we do not have a lot of economic transactions with these countries. So what we believe that since we have been very active in implementation of this, but then we need to do the following things. Number one is to make legislation under the regulations, and regulations would be in respect of Rule 1 and Rule 2. So we would need assistance, technical assistance in case of qualified domestic tax. We will need assistance in going for advanced transfer pricing rules to compute the amount in amount B in Rule 1. We also would need the assistance as far as the working of the amounts in the Rule 1 are concerned. As far as the automatic exchange of information, we have started getting the information since 2018, and this is the 5th time we have received the information. We have now a credible information. Previously, the data which we used to get was raw and not dependable, but now we get a better quality of data. We have started utilizing, and we have identified the cases of underreporting and non-reporting. So with the technical assistance of OECD and the assistance in taxation without borders, we believe that Mauritius would be able to implement the two-pillar solutions without any difficulty. And once we do that, we would be seen as a very credible international finance center of repute, because we would be BEPS compliant, two-pillar solution compliant, and the rules and regulations would be in place. Thank you.
Thank you very much, Director General. One of the points that you have just highlighted is the issue of the need for technical assistance. And as part of the historic agreement we reached last October, there is a specific reference to providing bespoke technical assistance to countries to ensure that they are able to implement all aspects of the two-pillar solution. And we've also heard from our panelists here, from the IMF and the 𝗐𝗶𝗴𝗶, that they also stand ready to support countries. So I think that is very encouraging. Let me now turn to our final speaker, Mr. Rajesh Ramral, who is the Solicitor General of Mauritius and is an assessor of the OECD Global Forum on Tax Transparency, and also very actively involved in our work in the inclusive framework on BEPS. Rajesh, you have the floor.
Thank you. Thank you, Grace. I'd like to thank the organizers here, the EDB, the Bank of Mauritius, the Ministry of Finance, for giving me the opportunity to share some of my views on this process, which started some years back at the level of the OECD, part of the BEPS, base erosion profit shifting project of the OECD. But my views on this development, I must say that as a student of taxation, international taxation for the last 30 years, well, I had to throw all my books, which I read 30 years ago, because it is such a sea change in rewriting international tax rules, international tax law. I think it goes to former Secretary General saying, rewriting 100 years of history of international tax rules. And how this came to be about, I won't take long, but in a minute, it is the way a new creature in the world of business called the multinational enterprise, which after the Second World War adopted business models that span across jurisdictions in a very seamless way and doing cross-border business, but that has been amplified by technology. And as you all know, we cannot stop technological progress. And the immense leaps we've made in terms of digitalization, of using IT, of using seamless technology, not only for scientific progress, but for business, became a challenge. And it was high time to look at the way tax rules have been laid out for the last 100 years. Now, it's always been said, is tax international? Is there anything called international tax? Actually, some eminent authors would say, no, there's nothing called international tax because taxation can only be domestic. Taxation is only to be decided by countries because countries are sovereign to decide on their tax policy. What is there in terms of international? But at the same time, for the last century, there have been treaties that have been developed, models of treaties that have been developed. You had the models of the OECD, you had the models of the UN, you had multilateral treaties from the Nordic countries, and so on and so forth. So it took a number of years for this to come around, but then with business models, digitalization, amplifying cross-border business, it became important to have a fresh look at how international tax rules work. And it became clear that it was not addressing all the issues that had been created by the business model that multinationals were using. So that is an important departure in terms of the premises. I've been listening to our colleagues here this afternoon on what we call the physical presence. Now it became clear that with technology, companies do business across jurisdictions without necessarily being present there physically. They don't need to be here or there. And I won't name companies in the world. We're talking of the big tech companies with the turnovers running into trillions of USD. And the absence of physical presence creates a number of challenges because the tax system and the tax rules been based on domicile, on residence, on physical presence. Whilst, the DG just mentioned, well, all that evaporated into space. So how do you therefore do the connection between digital work, business model, and value creation? And in one word, there was an interim report of the OECD in 2018 addressing this with, in January 2019, the policy report going into the details of how this is to be working and the two-pillar solutions. So the two-pillar solution is an attempt to rewrite international tax rules to address issues that created a hue and cry saying, do multinationals across the world pay the right, fair, and fair share of tax? That was the question that had to be addressed. And therefore, negotiations around developing the BEPS project, which started in 2015, the deliverables of the first 15 chapters of the BEPS project, and the first one, which is the most important action point 1, is addressing the challenges of the digitalization of the economies. That was the most complex one because this is the one that creates a number of issues we have to look at, and the others were kept going. And therefore, I think that this development goes into the way of addressing the gaps in international tax rules and the misuse of those by multinationals. Now, from there on, there are, of course, a number of difficulties we have. And this is what, as a group of countries, and this is the work of the inclusive framework, there with its initial works in Tokyo, a few years back, 2016, 2017, and the last inclusive framework was this year, 2-3 weeks ago, which I attended, and where we have made so much of progress there, trying under the pillar 1 and 2. I won't go into the details of that because my good friend Regis has touched on that. But yes, it is complex. One of my former professors said it is so easy to make tax complex, but very difficult to make it simple. So yes, there is a lot of things to be done to make it simpler, because at the end of the day, administrators will have to implement that. And of course, this is where capacity building and so on come into play. But one thing I'd like to touch on is under Pillar 2, we're trying to raise additional revenues, and that is in the tune of $150 billion US, and probably for the benefit of developing countries, provided it is made to work and they understand how this works. Now, it is clear that whenever we're going as a group of countries to decide on what is the minimum, and also to apply a new multilateral instrument, because that, after we've signed that new multilateral instrument, probably end of 2023, that will become law in each and every country. Therefore, to be ready to implement that. Now, it is clear that there are a number of challenges. One is what happens, for example, to the tax-paying clause in a tax treaty. Tax-paying clauses were already there. It was meant to make sure that you do not lose the benefit you get from incentives because of low tax policies at the very initial beginning of it. So what happens to that? Do they become OTOs? I hope not. I would think it should not, and I would join my friend Regis in raising those issues, because, well, tax incentives should not be wasteful. Countries should not give in to give tax incentive because there's a pressure from a multinational. And this carve-out is something which is extremely important to save those tax-paying clauses in tax treaties. And there, I think it is important to understand that what the OECD has been doing is try to conflate, to harmonize a number of different work groups. We also participate in the harmful tax practice, which is Action 5 of the BEPS project. So much has been achieved into setting the standards, under Action 5. And those carve-outs, and Grace mentioned that, the substance issue, extremely important, because you will no longer have subsidiaries with no employees, with no activity, with no real effective activity. Therefore, it's a total game changer. It's a new set of rules, I think, for even developing countries to benefit from, provided one plays according to these rules. Now, one of the things, and this is again one of the canons of taxation of Adam Smith, it should be simple and clear to be easily applicable. Otherwise, well, we would spend a lot of time to try to interpret that. And when you spend a lot of time to interpret, well, it's a heyday for lawyers and things get into court. And one of the things which also is important there is trying to have alternative dispute resolution systems in place. And part of the system is also to have ADR, is to have arbitration in place. And I think from my experience, there are few African countries that espouse alternative dispute resolution in tax matters. Mauritius is one of the few countries, I think the first one in Action 14, to have committed to have an ADR system in place. There are a couple of more African countries that have joined this. Alternative dispute resolution in tax matters is something which is part of the BEPS project, and I think this is the way forward, forward thinking and applying these new rules. I think I mean, this is history in the making, trying to rewrite the international tax rules, but on the basis of negotiations and trying to reach a consensus. Now, when it comes to Pillar 1, now, of course, I do take the point of the DG next to me. On that, the threshold probably is set at some point. I mean, I don't think this is cast in stone. Probably we will have to have a fresh look at it. The OECD's work not only with IMF, and I mean, part of this part of the world, we're talking of ETAF. ETAF is also a member of the IF, and therefore there is need to continue the work with ETAF on that side. So, Grace, that was my experience, my views on this extremely fascinating subject. Thank you.
Thank you very much, and thank you for raising some points that had not previously been raised. You just mentioned the issue of the threshold for Pillar 1. Indeed, it is built into Pillar 1 that within 7 years it would be reduced. And so you will see a broadening out of the number of multinationals covered by the Pillar 1 reallocation of taxing rights. You have to remember that this new system, which Regis rightly described as an overlay to the existing international tax system and the existing rules, is complex. And so starting at a very high threshold with the largest multinationals means that, in a sense, we can use them, and they are the ones that have the resources available to implement these new rules. We can then use their experience to revisit this, reduce the threshold after a period of 7 years. That is what is in the agreement. The other issue that you mentioned that is extremely important is the whole issue of dispute resolution and providing certainty. We know from our work, actually with the IMF, on looking at how businesses make investment decisions. One of the top things that they routinely raise is the issue of tax certainty in a jurisdiction. And so it is important to be able to provide that tax certainty in general, but also when you are establishing a completely new tax architecture, and where it is based on a formulary system which is an overlay to the traditional transfer pricing rules. We absolutely need a common dispute resolution mechanism to ensure that there is no double taxation. And so we've made very good progress on that. But with that, and I'd like to thank all of the panelists for their comments, let me now turn to the audience for any questions.
And of course, as mentioned earlier, if you have a question, please raise your hand, mention your name, and also please mention the name of the person you're addressing the question to.
The name is Innocent Mache. I'm from the Reserve Bank of Zimbabwe. Listening to you all, I see the complexity of the issues we're dealing with here. But I just wanted, mine is a comment, so I won't point out to whom it's directed. The issue of taxation indeed is complex, and I'm no tax expert. But what we learned with the intermediated transfer tax in Zimbabwe is that economic agents are getting quicker and quicker to adapt. And unfortunately, as regulators, we are, slower than them. So we are always playing catch up. And yet, as Dr. Tak said, we need to be faster so that we are not, regulation is not following implementation. So I think that somehow we need to find a way of quickening the pace of catch-up. What is clear is that also the game is changing all the time. So perhaps there is an element here of using AI much more than we are using it now. Thank you.
Thank you very much. Maybe I could give some reaction to your comments, and then if any of our panelists would like to react, I will invite them. I would say that you're absolutely right, that we are always playing catch up. One of the great things, though, I think about the minimum tax is that, in a way, it's the backstop to all of the other rules that countries have implemented, because no matter how clever a multinational gets in its tax planning, at the end of the day, they have to pay an effective rate of 15%, either in the source country or in the parent country. And so I think in that sense, that is an important step in terms of saying we're not playing catch up, but rather we've set a minimum. So this really is a major change in international taxation. And I think it could not have been done without this international collaboration. Why? Because individual countries also compete with themselves. And so if one country did it, they would be afraid that, well, the investments, et cetera, would go elsewhere. And so now, having a global agreement, there is nowhere to go to do this, and at least there will be a minimum effective rate of 15%. So that, I think, is one thing to respond to your question. And then, of course, artificial intelligence, yes, we encourage tax administrations to use this to analyze the data that they receive, and obviously as part of the two-pillar solution, there will be additional information reporting requirements from multinationals that then countries can use to better detect avoidance activity. But let me turn it to our panelists to see if anyone else would like to react. No? No? Okay, so we go to the next question.
We have in the front. Okay, we have two people. Both on your side. Thanks.
Yeah, merci. J'ai perçu la complexité de ce processus et de la mise en œuvre de la taxe. La question que je pourrais poser, c'est ça. Justement, quelles sont les conditions de mise en œuvre, étant entendu qu'il peut apparaître comme des blocages futurs sur notamment la promulgation aux États-Unis, le veto de certains pays européens. Quel est l'avenir de cette proposition de l'OCDE? Merci.
Thank you. Maybe I'll take that question as well, and anyone else can come in and join. The so-called veto you refer to in the European Union relates to the minimum tax. What is important to note about the minimum tax in Pillar 2, unlike Pillar 1, is that it does not require a multilateral agreement. It is for each country to decide whether to implement Pillar 2 and the minimum tax. And so, for example, Mauritius has already started the implementation. Australia has just announced they're going to implement. Switzerland has changed its constitution to implement this. Japan is in the process of undertaking the tax reform necessary to implement the minimum tax. And there are a host of other countries, including 5 EU members, France, Germany, Italy, Spain, and the Netherlands, that said whether or not the European Union enacts a directive to implement the minimum tax, they will do it unilaterally, and other countries as well, as part of the European Union, have indicated they may move in that direction. So there is no absolute necessity for the European Union to establish a directive to implement this. Obviously, if they do, then all European countries will have to implement the Pillar 2 minimum tax. But even if they don't, most of these countries will do it anyway because it is in their interest, because if they don't impose the minimum tax, another country will tax that income that they could otherwise tax. Now, with respect to Pillar 1, we do need a multilateral instrument, and that is what we are working on, and hope to finalize the text in April, latest May, so that we can have it signed at the end of June. And sorry, I should go back to Pillar 2 and the United States, which you mentioned. The United States enacted a reform recently which did not go as far as implementing the Pillar 2 minimum tax, but they did make certain changes and did establish a minimum tax. Prior to that, they established what is known as GILTI. I won't tell you what it stands for, Global Intangible Low Taxed Income. That's the acronym. But that is a minimum tax which actually inspired our Pillar 2 minimum tax. Now, they are not the same, and there are some key differences, but we always understood, and there is a provision in the landmark agreement of last year, that we would consider a guilty coexistence measure, and that is yet to be worked on, but that is the idea. How would we treat the guilty provisions, which are not identical to the Pillar 2, recognizing, though, that they go a long way towards that. But I think on the minimum tax implementation, it is already happening because it is of great interest to countries, and they can do it through domestic legislation rather than through a treaty.
Thank you.
A comment now
Thank you.
from, sorry, but Régis would like to make a comment.
Oui. Si je comprends bien là aussi, un aspect de la question du secrétaire général, c'est quand est-ce que tous les pays du Inclusive Framework vont mettre en place cette question. Et je crois que c'est un aspect que n'a pas adressé Grace. Encore une fois, pour que la mise en œuvre de cette initiative multilatérale soit globale, il faudrait évidemment que tous les pays soient en board, mais pour cela, il faut tenir compte de ce que j'avais mentionné lors de mon intervention, c'est-à-dire que les processus législatifs de certains pays qui peuvent mettre plus de temps que dans d'autres pays. C'est juste un aspect que je voulais ajouter à ce que Grace vient de mentionner. Merci.
Okay, thank you. First of all, thank you, panel members, for sharing your insights on this challenging topic. My question goes to Mr. Lal from the MRA. Mr. Lal, I mean, any idea on the impact of the implementation of this two-pillar solution on the revenue collection in Mauritius?
Well, you will appreciate that it's premature to work impact assessment in the absence of the data and the details we would require. However, as I submitted, that under Pillar 1, we do have companies, the subsidiary companies, whose parent company, the total global turnover is about 20 billion, and the turnover of those companies is 250 million euros. And we believe that in those companies, we will get some additional amount of tax. How much, we probably would not be able to say at this stage. As far as Pillar 2 is concerned, it has 2 to 3 subcomponents. One I talked about STTR. Now in STTR, the threshold is 9%. So royalty income is already taxed at 15%, so it will not be affected. As far as the interest income is concerned, now this applies to the countries with we have treaties, and in those countries, I probably already submitted that there are only 3 countries, Bangladesh, Cyprus, and Congo. So it wouldn't have really any impact. It's not on dividend and capital gain. As far as, again in Pillar 2 is concerned, there are many companies whose average revenue is less than 1 million. Those companies will not be affected, so we will not have any adverse revenue effect because of the clause of de minimis. And as far as the Mauritius is discussing this in Working Party 2, and the discussions there and the conclusions drawn will be very relevant to Mauritius. But just to give you an indication that the companies, we have country by country reporting of the 750 million threshold. So we have 13 ultimate parent entities and 856 constituent entities. So these may be impacted by the global minimum tax of 15%. But again, we would try to persuade these companies to have substantial activity requirement in Mauritius, and then these companies will get benefit from the substance-based carve-out, and therefore impact of these rules will be minimized. But if they don't do that, there will be an impact on them. How much, we really don't know. I mean, it's too early to say anything. Thank you.
We'll have one last question, please.
Thank you. My name is 𝗘𝗰ance from a multinational company. So as we are talking about tax challenges arising from digitalizing our economy, Already we have seen that Africa is behind in many ways in terms of digitalization. So how far do you think Africa can catch up by implementing the minimum tax?
Maybe I'll give a brief answer. I think there are two things. One is Africa catching up in digitalizing its economy and digitalizing its tax administration. And then what we have here, what we're talking about with the two-pillar solution and the minimum tax, is really addressing tax avoidance by multinationals, including those highly digitalized multinational companies, the tech companies, but not only. And so I think that the minimum tax will go a long way to increasing revenues for developing countries. In fact, it will have a much bigger impact on developing countries than on developed countries, because they will be able to, one, get rid of wasteful tax incentives, and two, be able to collect tax to the extent that certain profits earned in their jurisdiction are currently taxed below 15%, because they will be able to tax the difference between whatever it is and 15% through the qualified domestic top-up tax. And so I think there will be a revenue benefit. Does it help them become more digitalized? No. I think there are other measures and efforts that other organizations can take to help the tax administrations become more digitalized. We have been working through our Forum on Tax Administration to help that the tax administrations around the world use technology to improve their tax administration. But what the minimum tax will do is bring in more revenues to finance that, as well as achieve the Sustainable Development Goals.
All right, I think your remarks brings an end to this question and answer session. Ladies and gentlemen, distinguished guests, so we have come to the end of this second panel discussion, which also means that we have come to the end of the first day for this international conference on digital economy and digital bank. Can we please have a big round of applause for our panelists? The moderator, and all those who participated by asking questions, and for those sharing your views. We have another day waiting for us tomorrow, so I give you rendezvous as from 10 a.m. here only for the registration exercise, and as from 10:15 we shall begin with a presentation on digitalization and AML CFT challenges. Until then, thank you very much for your attention and for being such a lovely audience. I remind you there's a coach outside at 5:30 for those of you who are attending the gala dinner. We wish you a wonderful evening and see you tomorrow.